specific mandate to be fully invested. Whether that's the mutual fund manager or the institutional manager, they do not go to cash because their mandate is to remain invested. For us, we have the beauty and the freedom. We don't have to stay invested.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. This next guy has over 30 years of management experience in the investment business. He's a founding partner of systematic macro investment manager, Incline Investment Management. Now, what the heck does that mean? Well, it's really focusing on the emerging and global markets and all these verticals, and we're going to be diving into that because some of you guys are not realizing the massive opportunities outside of the U.S. market, which is we're very excited about. He's registered with the National Future Association as a principal and associated person of IIM. He is also the managing partner of Incline Investment Advisors, like I mentioned, a wealth management firm and registered investment advisor. He's also a former assistant professor of business at Sierra Nevada College in Incline Village, Nevada. Prior to IIM, he was the director of marketing for Zazove Associates, a multi-billion-dollar quantitative convertible securities manager. He was also a senior marketing executive at John W. Henry and Company, one of the original commodity trading advisors. Please welcome my next guest. He earned his MBA from Cornell University, the one and only Ted Parkhill. How you doing today, Ted?
I'm very well, thanks, Christian. That was a very kind and thorough introduction. I appreciate that.
Well, Ted, I'm really excited about having this conversation because, like I mentioned, one of the things you guys have been in this business for, you're the managing partner at Incline Investment Advisors for coming over around 7 years now, which is really incredible. And before you got into this thesis, before we dive into the global markets and all the verticals that you guys all the fun vehicles you guys are really playing in, Ted, what point did you start realizing in your journey, you started realizing, okay, hey, I see massive opportunity in some of these unorthodox ways of investing that maybe people don't have access to, or maybe people are not aware of. So where did that idea come from, Ted?
Well, it actually goes back in time because I've been interested in markets since I was in high school. I was sort of Michael P. Keaton back in the days. You know, my dad was a broker. I was interested. We talk over the dinner table about markets, and I've always sort of had a global awareness. I didn't grow up in the U.S., so that perhaps was a factor. I watched U.S. news, I watched Canadian news, and I sort of had this awareness about the world. Early on, I got my futures license when I was 22 years old, and I earned it for fun because I was interested in markets. And my dad's advice to me at the time, though, was not to follow in his footsteps, was to go corporate, work my way up, and that's what I did. But I always had an interest in the markets and trading and the opportunity set that existed. And fast forward in my career, I ended up having this fantastic opportunity to go to work for John Henry. John was, as you mentioned in your intro, was one of the original quantitative investors. And at the time, it was almost pre-internet. There wasn't a lot of information about him. So I was going into this opportunity not really knowing. When I got there, on day one, I drank the Kool-Aid. I was like, this makes so much sense. And the really neat part was, and I get there and they say, oh, by the way, you need your futures license. I'm like, well, that should be easy because I had it when I was 22. And by this time, I don't know, I'm in my mid-30s. And so I'm like, I can do this. So I got my license. And for me, it was, the light bulb went on. It was almost an epiphany. Like, this makes so much sense. To have a quantitative approach to markets was just so logical. Why wouldn't you do that? Like, why pretend to know? And John, to this day, Mr. Henry, is the worst interview. So so you don't want to put him on your podcast because you'd ask him something like, oh, Mr. Henry, you made a lot of money trading markets. How? And he's like, well, I don't have a view. Like, he's just no help at all. And it's because he believes that if a market is going up, you want to own it. And if a market's going down, you want to be short. And I'm looking at that going, that makes so much sense. Along my journey with working for Mr. Henry, I started to formulate some ideas on how to do it differently, maybe even better, and at the same time control risk. And that's one of the things he was never worried about. He didn't worry about volatility. And one of the things that I came across over my journey with Mr. Henry was clients do care. Investors do care about volatility. So I started thinking about how to build this, offer the exposure to the global markets that we thought could deliver returns, attractive returns, but at the same time build it so that we could manage the vol. And to us, that was the objective. And so it was sort of post-financial crisis that I realized when so many of the quantitative managers did so well, when everything else wasn't, I'm like, okay, it's my turn. So I went to start my own and started. It took about 2 years to build, and we've been running the same strategy since 2012.
So I love this strategy as well because it's very unorthodox, or I should say it's not very well known. It's not mainstream. And that's why I think it's really important to have people like yourself on talking about this to our audience so they become aware of this strategy. Now, I want to ask a little bit further, Ted, in regards to the evolution of this. So you, like you mentioned, many years ago to now, there's been a lot of ups and downs, different global markets that you've optimized. Ted, if you could maybe look back at that journey and identify maybe one or two or three things you're seeing back in the day that are kind of like almost a circular situation. Maybe it might be your Europe markets a little bit. You're like, okay, that's intriguing. There's some capacity there. We're seeing emerging markets like India and China kind of coming up a little bit. Are there some circular kind of movements of kind of same patterns that you're noticing for being in this industry for so long? What are you seeing now, Ted?
Yeah, that's an interesting way of asking about why does it make sense to have global exposure. And one of the things that we know about most U.S. investors is they wear their U.S.-centric hat, right? And that's natural. That's true in every country. Every country has a country bias, right? So people who live in Argentina are invested where? In Argentina, right? And that's natural, and that applies to almost every country in the world. So in the U.S., it's no different. And so one of the things that we started to look at is we wanted to go beyond just the U.S. market. U.S. investors are already heavily invested in the U.S., whether it's through their own real estate, their primary residence, and through their 401k, their IRAs, etc. They have exposure to the U.S. market. And so one of the things that we do for investors is we go beyond the U.S. We actually track and trade over 100 different global markets. And that is a very wide opportunity set. We cast a very wide net to find the opportunities in the markets that we're tracking. We may not be fully invested in all 100 markets at any given time. We might have exposure to 20, maybe to 30 markets. And why? Why do we have exposure just to that sort of concentrated group? It's because we're looking for markets that are moving. So we look for markets that trend, and ultimately people call us, we're a trend follower. We look for market movements. So if whether it's the Japanese government bonds, whether it's the Australian dollar, whether it's frozen orange juice or cocoa or oil, we are looking for markets that move. And so we're trying to create that opportunity set. It's not mainstream. Everyone thinks Warren Buffett's the greatest investor ever. And actually, arguably, he kind of is, right? That approach does work. It doesn't mean to say he's wrong when we take a quantitative approach to markets. In fact, we would argue that having a well-balanced portfolio is you would have a great deal of what Warren Buffett does, and you'd have a big sliver of what we do. And to us, that's better diversification. And I can talk about why, but certainly we think that that's why it makes sense to have the exposure, why investors are looking for opportunities beyond just the U.S.
Yeah, and we're going to dive into a little bit micro in regards how you guys structure that, what that vehicle looks like a little bit in those 100 kind of different, verticals, if you will. But I want to talk a little bit about on your website and kind of reiterating what you're mentioning here in regards to your approach, systematic approach. You say on your website, inclineim.com, you talk about there's really 6 pillars in regards to this. And you guys basically say we don't make attempts to predict the future. You guys really focusing on defining a trend, entering a position, exit strategy, volatility inputs, dynamic approach, and risk management. Those are the kind of the 6 pillars. And then each one you kind of identify a little bit further in regards to kind of your thesis. I found that very interesting. I'd love for you to maybe just talk a little bit about that approach at a more of a micro level, understanding for my audience and myself as well, kind of that whole thesis. And then we're going to dive into kind of those vehicles and what that looks like and the trajectory behind them.
Sure. When you I mean, that's the micro, I think. So if I'm moving there, Christian, I certainly can. It really, when you're building a quantitative strategy, what a lot of people don't realize is you're building an algorithm. You're building something that's going to apply across different markets. Like, what does cocoa have to do with oil? Are they correlated? And there are some quant managers that look at the cross correlations between markets. We don't. What we're looking specifically for is markets that move, that break out of their ordinary or established volatility band, if you will. So if something is just chugging along horizontally, we look for that upward movement. If we see that upward movement, we're going to take a position. At the same token, we're looking for any downward movement too, because we have the beauty of being directionally agnostic, which just means that we can take advantage of directional moves in either direction. To us, that's a huge advantage over the typical buy and hold investor or buy and hold strategy, because that's the mindset most investors have. That's what they learn in school. That's what every investment manager has told them. Don't worry, we're going to buy it, we're going to hold it, and even worse, if it goes down, we're going to buy more. We have the complete opposite mindset. If it goes down, we're out. Like we get stopped out on every single trade that goes against us. And so it's interesting because it's just philosophically so different. If we have no ego built into the decision-making process, we apply the same algorithm across all 100 markets that we're trading. And we can do that because we look at all the markets similarly. Now, granted, each market may have a different level of volatility, so we adjust the position sizing accordingly. So if a market is trading in a very wide band of vol, we're going to take a smaller position with a wider stop. If a market's trading in a very narrow band of volatility, we can take a bigger position but with a much tighter stop. Same amount of risk on each trade, but that's how we build it from a position standpoint. So we look at liquidity, we look at position sizing, we have a stop on every trade. The stops will change over time as the market either goes in the direction we think it will or not. From an asset standpoint, we're diversified across all of the different markets. The entry-exit points are built into the algorithm, and overall, the diversification is built in because we're tracking all of these unrelated markets. At the end of the day, our performance tends to be non-correlated. Over the 10-year plus results that we have minus 0.01 correlation. Like, it's unbelievably non-correlated. At that point, I probably should add my little disclaimer that trading futures is inherently risky, and there is risk of loss, and past performance is not indicative of future results.
Well said, well said. And and this is for educational purposes. So, Dan, I appreciate you unpacking that at a micro level. And let me ask you this. So when you're looking at these global markets, is there a little bit like at a macro or maybe a micro level, are you kind of adjusting for the trends as well as maybe anticipatory? Like, hey, we're realizing, okay, there's certain news coming out, there's certain things happening. For example, the reason I'm going to say this is because people are very well known. Not a lot of people are very familiar with a lot of news externally outside of the U.S. We're just very U.S. focused with the news. But like Brexit, for example, again, that's kind of developed, it's passed, whatever. But my point is that was very well known. A lot of people here in the States were very somewhat familiar with that. There was chaos a little bit. And in that chaos, though, there's opportunity. And so I'm curious, when you were looking at that, how did you structure, how does your team kind of focus on that and say, okay, hey, how are we going to optimize this opportunity?
Yeah, and that's a great question too. But here's the thing. That question is a traditional question because it applies to what most traditional investment managers actually do. When it comes to the quantitative side, we don't look at those external inputs. We look at one input only, and that is price. Because from our perspective, price is a reflection of every market participant's view. So if you think it's going to go up and somebody else thinks it's going to go down, ultimately that both those views are reflected in that price of today. The way I describe it is I take the cocoa market. I mentioned that before because it's a great market. The primary producer of cocoa is Ghana on the African west coast, right? A lot of us don't know a lot about Ghana. My sister and my mom have been to Accra, with the capital. It's a really cool country. I definitely want to go there. It's English speaking. It's a member of the Commonwealth. Really cool place to go. And you'll meet Ghanaians around the world, often in New York, and they're the friendliest people. It's an awesome country. They produce a ton of cocoa. If there was a coup in Ghana tomorrow, which I don't expect there will be, but if there were, what would happen to the price of cocoa? Chances are cocoa prices would skyrocket. I can tell you that as a quantitative manager, I am not following politics in Ghana. I'm not following whether there is a frost, not that there ever would be. I'm not following the cocoa production or the levels of cocoa. Or another case in point would be corn in the U.S. It's subsidized. Is Congress going to re-up the subsidy, or is there going to be a frost in Iowa and kill corn? No. We're not following any of the fundamental inputs to the markets in which we trade. That's counterintuitive because most people expect as an investment manager we would be, that they want their investment manager to know more about the market than they do. Well, I'm sorry to say, but also proud to say, that we are not looking at those fundamental inputs. We are only tracking price, which is exactly why we are called trend follower. Because as a trend follower, we're looking for movement in price, and that's all we're looking at. And to us, that's the way that you can take advantage of profitable moves in all of the different markets in which we trade. That's why we track so many different markets, because they're not all trending at any given time.
Interesting. And so, okay, this makes perfect sense. I appreciate you explaining that and kind of helping me understand there's the difference of the way to look at it, have that conversation. I want to loop back into what you mentioned previously as well in regards to having that stop loss. Pretty tight, but the risk tolerance is basically the same, but just the way the volatility of that, and that's how you approach it. When you're looking at that investment thesis, you mentioned a few of those things there. What are other green flags that you're looking for? You're mentioning the trend, you're mentioning the volatility, you're mentioning kind of the momentum, the trend a little bit, and then obviously the structure of it as well. Do you guys ever put any like put options? Like if you buy something and then put options to anticipate, hey, it's going to go down for a little while and we're going to obviously, maybe have a negative loss for a while, but then obviously it will go up, or vice versa in regards to whichever strategy you put in?
No, that's a good question. And there are strategies that do that. Like there are strategies that, and you mentioned, or you asked a little bit about your previous question about being anticipatory. So we're not predicting the future. We really don't know what's going to happen tomorrow. In fact, our argument and our standard, sort of our core philosophy is we don't believe anybody has a better crystal ball than anyone else. And if you ask an investment manager in Boston or New York and they're interviewed, well, this is your business. You ask them, what do you think is going to happen in the market in 2023? They will give you an opinion. In fact, they're paid a lot of money to have an opinion. But our argument is, at the end of the day, that's all it is. It's just an opinion. They actually don't know. And even if they got a call from the big guy above that said, hey, they're on the red hotline, of course, sell, because everything's going to just go, the world is ending tomorrow. Sell. Do they? No, they don't sell. And the reason is because they've been hired with a specific mandate to be fully invested. Whether that's the mutual fund manager or the institutional manager, they do not go to cash because their mandate is to remain invested. For us, we have the beauty and the freedom. We don't have to stay invested. In fact, our investors hire us. If the world is ending tomorrow, we're going to be short. That's the beautiful part, is we can make a ton of money on the downside too. And so we believe that if we stick to our knitting, we follow the directional moves, so that if we see a market that's moving down, we're going to be short that market. There's very few investment options that out there today that allow investors to take advantage of the downside. And it's sort of awkward a little bit because people aren't really comfortable making money when things are dropping. Our view is, though, get used to it. Because we saw what happened in 2022. Who could have predicted tech would be down over 30%, almost 33%? Who could have predicted that the S&P would be down almost 20%, right? Do you want to sit around and have your 401k drop by 25, 30%? Well, it's because I believe it was, I just have to hang on. I'm going to buy more. That's when dollar cost averaging is out the window. From our viewpoint is you don't sit around and watch that happen. And so, of course, in 2022, we had a pretty good year because we were able to take advantage of global markets that were in decline. And there were two big trades that we could talk about if you want me to cover sort of what happened in 2022.
Let's dive right into it, man. Let's keep going. Yes, let's dive into those trades, man.
And it's because we're brilliant. That's the real answer. Glad you asked. The answer, I say that tongue in cheek, because there were two big obvious trades. And something weird happened in 2022 too, for us. Some of our bigger competitors actually, for the first time in years, outperformed us. And we know why. We're not embarrassed. We're not apologetic at all. Some of the big players in our space, in the quant space, only focus on the financial markets because of their size. They don't get to trade. They can, but it'd be a rounding error, so they don't get to trade markets like corn and cocoa. Okay? We do as a smaller, more emerging manager, size manager. So over the past several years, we've done a great job of outperforming the big guys. But the big trades last year, the big themes were global bonds and strength of the U.S. currency. So when I say strong U.S. currency, that means the U.S. dollar is appreciated against global currencies. So anybody that was long the U.S. dollar and short the euro and short the pound made a ton of money on those trades. The big players were in that trade all in. Okay. The second big theme and the trade, everyone thinks equities. Oh, equities are down, so you must have been short equities. Yeah, at certain periods of time in the year we were. That isn't where we all, the quantitative managers in the space made all the money. The money was made in global bonds. Now, you have to put your thinking cap on that for a second. How does one make money in global bonds? Well, it goes back to the basics. Everybody knows that when interest rates rise, bond prices drop. In general, people know that, right? Well, we haven't seen rising rates in 40 years. And in 2022, we saw rates rise. And so the big theme was to be short global bonds. And the big players did it, we did it, and it was a great trade. Now, what's interesting about that is, when was the last time an investor that's listening to your podcast today had the opportunity to short global bonds? Did their broker from one of the big wirehouses in New York phone them up and say, hey, you better short bonds. It's a great trade. No one does that. And in fact, Christian, I'd really like to meet your guest that comes on and says, oh yeah, I'm a broker and I had all my clients short bonds. And I had the approval of the mothership to do that. Okay, I want to meet that guy. But seriously, that is just not common. So from our perspective, that was just, now, I made the tongue-in-cheek comment, it's because we were brilliant at face value earlier. But it's not true. What started to happen is rates ticked up, bond prices started to drop. So it became apparent to us that the trend in bonds was dropping. We didn't take a short position in bonds because we knew great rates were rising. It's because rates were rising. There's a big difference. That goes back to your question about anticipatory. We weren't anticipating it. We reacted to it. That's the nature of being a quantitative investor.
That is brilliant, and I love that differentiation a little bit. You mentioned here, and I want to dive into that a little bit further. When you take a position, and you're kind of directional agnostic, which is good, right? Obviously up or short, whichever way that is. Do you guys have like some sort of top line, your exit, what that looks like in regards to, hey, this is going to go up 300, 400, basis points, and then we're going to have an exit, or we're going to have, take 80% off the table and then let the 20% ride? What is your guys' thesis in regards to that?
Yeah, that's a great question, because now we're into sort of the micro, sort of the strategy itself. And there are managers that do that. In other words, there are managers that do slice and dice this in different ways. And we decided to keep it simple for the most part, because we realized simple actually worked. There are pros and cons to that, though. We recognize that. So we're never going to get out of the top. And we don't have a target profit on any trade. Our best scenario is when the market goes in the direction in which we took the position, It goes up on a beautiful smooth curve, and then gently rolls over, and our stop catches up to the rollover, and we get out, and we maximize the profit. Where it gets a little tricky, and where on occasion we'll have a month where we're down more than normal, and people say, oh, you had a terrible month. It depends, because what typically could happen is we take this massive profit, and then our stop, because there's been an exponential move up in that market that we're trading, our stop hasn't kept pace, and then the next month there's a sharp cliff. And in that sharp cliff, we'll give back a lot of our profits. It'll look like we lost money, but actually we're just giving back a lot of what was on the table, because it didn't roll over. And so one of the issues is that in those situations, we will accept it for what it is and not worry at all. So we'll never get out of the top, and and conversely, with a short position, we'll never get out of the bottom. It'll have to roll over before we get stopped out and close out the short.
So correct me if I'm wrong, basically, and let's just make this as a kind of analogy. You buy it at $10. It went up to $20. Your stop loss was at $5. So if it went down to $5, you'd stop loss. Wonderful. In this case scenario, what happened was it went up to maybe 22, and then it dropped down to maybe 11 or maybe $9. And that's kind of why that discrepancy, just putting that into context, correct?
Okay, close. That's close, but I can do better. So think of it this way. Just taking broad numbers, for example, we buy it at $10. Our stop might be at $9. Because we know it's a tight stop. We know how much money we're willing to risk on that trade. Okay, but then it goes to 15. Our stop doesn't stay at 9. It's a dynamic stop, which you mentioned earlier and I probably didn't touch on. The dynamic stop will move with the market. So now the stop's at 13. Notice that it's not necessarily 1-to-1. So it didn't go 50, it's still not a $1 move. And then it has a really sharp move because there's news that comes out. It's, oh my gosh, it's a great market. And it goes to 20. Where's our stop? It might be at 15. So now we have this gap. And slowly over time, they converge. If it stays at 20, our stop catches up. It gets to 16, 17, 18 over a period of time. Where we have some profit risk is where the stop stays at the stop's at 15, and suddenly it drops from 20 to 15. It looks like we lost $5, but we didn't. We actually made $5 because we went 10 to 15. It did go to 20 and then dropped off the cliff back to 15. We got stopped out. So from our view, we made $5. It's like, whoa, that was a great trade. And somebody looking at our monthly performance might say, yeah, but you lost $5 because it went from 20 to 15. Well, that's true. We're not worried about that at all. That's part of the built-in volatility that we're willing to live with. And one of our original objectives for our flagship strategies, we wanted to build a strategy that had what we call equity-like vol. Most investors are comfortable with equity-like equities, owning equities, so they're comfortable with volatility of equities. So our original objective was to build a strategy like that. Unlike the John Henry days, where in the John Henry days, he had vol of 30 plus. Not every investor can handle that. So one of our original objectives is to try to build a strategy that delivered what we call equity-like vol. That's why. And that's kind of how we do it, because we have the trailing stops that manage the downside risk.
This is making perfect sense. And for those that are listening, that maybe that was you didn't quite understand or weren't picking that up. That's one of the reasons why you need to reach out to Ted and his organization to have this conversation, this dialogue, to unpack it, because this is an incredible thesis. So I really appreciate you unpacking that and kind of reiterating the mistake that I mentioned there. So I really appreciate that. Now I want to talk a little bit about, you mentioned offline and a little bit previously, you have 100 different kind of vehicles. I like to say vehicles, 100 different kind of options options, opportunities, because and out of that doesn't mean that you're trading 100 actively. It means out of those 100 that you have access to, maybe you only trade 15 or 20. You were telling me offline a little bit. I want to talk a little bit about at a macro level what those vehicles entail, because you were talking currency, you were also talking different exchanges globally, and for those that may or may not even be aware of these exchanges, and it's actually really, really quite remarkable. So if you could maybe just touch on that for us, Ted.
Yeah, absolutely. I mentioned earlier in today's talk that I'm Canadian. I'm from Winnipeg, so I grew up with the home of the Winnipeg Commodity Exchange, where they trade canola, and we actually trade canola, and we made a bunch of money actually. We often will make money in the canola markets because it's active, it's got volatility, it's a market that moves where we can profit from trading it. And it's just an extension of the examples I've used already. It's canola and corn and all the agricultural markets that we trade. My standard joke that I still use because I like it, and I have a dad joke sense of humor, and that is the frozen orange juice market is a market we trade, and it's the least liquid market of the markets we trade. I can't help it. So
that's brilliant.
But it's true. Most investors will not have exposure to the frozen orange juice market, but it is indeed one of the markets that has enough volatility for us to include in the strategy. So everyone gets, when we say commodities, and there's a bit of a misnomer in our world, and it's partly because of the U.S. government. Back in 1973, they created the Commodity Exchange Act. And they created the CFTC and all that, and the NFA is our self-regulatory organization. The NFA is the National Futures Association. And we're registered, and you mentioned it earlier, we're registered as a commodity trading advisor. And we're registered as a commodity pool operator because we run a private investment vehicle that is considered a hedge fund, effectively, right? So when you hear the words commodity, you think, oh, commodities, corn and oil and gold, those are indeed commodities, right? But the world grew and shifted and became more than just the physical commodities. And so we trade all of the global markets. And the global markets, so the three primary sectors in the commodity world, which are the ags, which we've talked about, the precious metals, which we've touched on, the energy markets like oil, natural gas, we trade emissions, we trade unleaded heating oil, and so all of those. The ones that people like to know about are the gold and copper, palladium, platinum, zinc, aluminum. Those are kind of cool. But we also trade and track all of these global financial markets. I touched on global bonds. People don't think of Japanese government bonds, Canadian bankers' acceptances, the Boon, the Schatz, the Bobble. They don't think of all of those, the sterling gilt, etc. I think those are kind of fascinating. That's the global fixed income. We trade all the global equity markets like NASDAQ and S&P 500, but also Hang Seng, Nikkei, FTSE 100, CAC 40 in France, the DAX in Germany, etc. And then we also trade the currencies. These are all considered futures markets. And so the currencies that we trade are all the ones you know: Australian dollar, British pound, the euro, Swiss franc, Japanese yen, New Zealand dollar, Mexican pesos, etc. And so those are all considered under the purview of the CFTC, the Commodity Futures Trading Commission. And you think, what? How are those commodities? Well, they're designated commodities because they're derivatives, they're futures contracts on those markets. The average investor doesn't know that or realize that. So when we're registered as a commodity trading advisor, it's, to me, the regulators should be most concerned with how misleading that is. They're supposedly out for the consumer protection. Well, why don't you start with figuring out what we're called? Because to me, that is misleading. And I make a point of explaining that to every single investor and client that we have. That we're more than just commodities. That's really important disclosure, in my opinion.
So when you're looking at, this is very important to understand these, and that's why I wanted you to explain a little bit about those vehicles, if you will, those strategies. Now, when we're looking at right now what's happening, and I want to keep this evergreen a little bit, but also I kind of want to, a little bit of what's happening with the global markets. I actually have invest a little bit of India. I see that as just a very interesting kind of ecosystem. There's got a lot of tailwind. There's still a lot of corruption, countrywide, but there still is a lot of innovation, potential behind that. I'm just curious. I do know like your strategy is not like, oh, we're going to do macro and then invest in that big trend. It's more of like, okay, hey, case by case situation. But I'm just curious what you're seeing holistically in the global markets. Are there certain, maybe just for our audience to be aware of, maybe like South America, there is a lot of stuff and opportunity down there, or there's other different global markets that we're not aware of that maybe we should be, researching a little bit.
Yeah, that's a good question, and I personally agree with you. I think India just is such an untapped has untapped potential. And as they come into their own and they sort of unleash the productivity potential of the Indian market, there's so much. It's incredible, right? We don't trade. There are no futures contracts that we're trading in India presently. We are looking at some of the new futures contracts coming out of China, and we've been in talks with some Chinese brokers. It gets a little tricky because we want to make sure our client assets are secured first. So when we're dealing with China, that is one of our primary concerns. Where is the money held? Who's the custodian of the actual cash? So we're very, very conscious of that, and we haven't worked out all the details in regards to how or the best way for us to trade the Chinese markets. But your point being raised is just on how interesting the world is and just how much opportunity there is. South America being another example of there's a great deal of potential there. If China starts coming back on stream post-COVID, China, the demand for commodities is going to be huge, or could be, and we're going to see, we could potentially see some spikes in commodity prices, which is going to be a great thing for us in general because of the commodities we trade. But there are some interesting commodity futures coming out of China that, there's iron ore, and there's pig iron, and there's a bunch of weird ones, or weird to us because they don't exist yet here in our world, in sort of the Western world. So we are exploring that and have been in discussions with them for about a year now, and we're seeing. And that goes back to sort of our overall philosophy of casting a wide opportunity set. If places like India come online and they start, and there are some more secure sort of financial contracts, futures contracts we could use, then we will be looking at them and seeing how they apply to our existing model. That's the only time when new markets get included. There has to be enough liquidity for us to include it so that we're not stuck at any given moment. And those are sort of the criteria that we look for when we're looking at global markets.
I'm just curious, we've had a really good conversation in regards to it, and we're going to be talking a little bit more, but I just want to stop here for a second. Why do you think this is not as well known in regards to global emerging markets and so forth for the investing world? A lot of individuals mainly focus on the U.S. base or maybe some, kind of neighboring, countries. But really, why do you think that is, and why there's just lack of information? Is it just very? Well, I'm just curious. What is your opinion on that, and why that is? Because there's huge opportunity externally outside of the U.S.
Yeah, that's the $20 question. Because I actually don't know. I mean, I think having an MBA, going back to my business school environment, I know it was taught, and I got a very traditional education, and in that sense, because that's what's taught in the business schools. That's from undergrad to graduate, is that we focus on what we know. And there isn't a lot of emphasis on including trading, tracking world markets. There just isn't. And so what I find interesting is the average investor just never gets that exposure. You phone your average broker and they don't know it either. And they don't have the investment vehicles to find it either. The mutual fund, a mutual fund can't short markets. You can't deploy a strategy like ours without the ability to short. It becomes very limiting quickly because then you're only looking for moving markets on an upwards trend. And that becomes more challenging. And then it doesn't actually have the impact that it should have. So I think that's a factor. Mutual funds are hamstrung. And so there's a sort of an opportunity set for the private fun world to create strategies like we have. And then it's a regulatory issue too, because a lot of times you have to be a high net worth investor. You have to be accredited oftentimes to access these types of strategies, which again, I could probably get on a soapbox to argue, because from our perspective, it's prudence. To us, it's more prudent to be able to be short markets in general when they're dropping, like last year. Oh, but the regulations say that if you're unsophisticated, you have to stay and watch your portfolio drop 33% like it did in tech last year. Oh, that's really protecting everyone, isn't it? You know, that's the irony. Like, why don't we apply some modern portfolio tech theory to the regulations? That would make way more sense to you know, quant managers like ourselves. If you look at modern portfolio theory, it suggests that if you add non-correlated assets into the overall portfolio, you can actually lower risk and increase return. Well, you should do that all day long. But that's not really built into being an accredited investor, which only has an asset test, not a sophistication test.
Yeah, and I'm glad you were just talking a little bit about this, because I am very passionate on this. One of the reasons why I want to have you on is to bring awareness to this kind of asset class. Because at the end of the day, Ted, I was talking to Sachin Kanjaria, which was he was a managing partner at Apollo. And anyways, we were talking about alternative investing space and how it actually outpaced almost like 3-to-1 the public markets. And the whole point is, and even in the alternative space, there's real estate, there's natural resources, there's obviously private equity, there's, you know, all sorts of different kind of verticals in that. And, you know, it got micro with it. But my point is regardless, alternative investing always outpaces it. And definitely in today's world where there's taxation, there's inflation, there's all this stuff that you really have to fight against, even the management fees, et cetera. It's like these individuals, these investors really are only, you know, squeezing out maybe 1 or 2% gain if you're not really thinking about, you know, alternative investing strategy. And so that's one of the reasons. Yeah, go ahead.
Well, that's right. And that reminds me of a point that I like to I got on my soapbox briefly there, Christian, but I'll stay on it for a second. That goes back to what's a hedge fund, right? And early on, the Albert Jones model, you know, a hedge fund was actually hedging. You know, they'd actually deployed a hedge to the exposure. So it was protecting downside with long exposure with protection on the downside, right? And there were various ways of creating that hedge. But along the way, somehow the industry went off on a tangent. I don't know whether that was the press or what, but now hedge fund, the term hedge fund, includes every private fund. Most hedge funds don't actually hedge anything. And it's like, well, why are they even called hedge funds? So there's a problem there. And so what I would encourage investors to look for is what kind of, if they're looking at these private investment vehicles, because that's what they should be called, you know, consider what their objective is for investing. Is hedging important? And does the private investment vehicle actually offer any level of hedging, which in other words, the definition of hedging is managing risk, right? And any due diligence should be considering what type of risk controls or what type of risk management is built into the process. And I think we're going to discover a lot in the next couple of years how a lot of these private investment vehicles don't really have a lot of risk management. And I think where we're going to see it is perhaps in some of these private equity and venture capital funds, which are, you know, alternative investments, which they are, but the question becomes how much risk management have they utilized? And as things start, if the market unravels here in the U.S., we might see more talk about that going forward.
I love this philosophy. And like you mentioned, it's just so convoluted right now, and I appreciate you kind of just sharing your thoughts on this. I want to ask real quick on a side note. I don't want to talk about crypto itself. I want to talk about tokenization, leveraging the blockchain. And I'm just curious, do you see, because I know with the Jobs Act and the SEC guidelines, they are kind of bringing that down to re-engaging, like what does a credit investor mean? Maybe they could get some education and then it could be whatever, right? There's talks around that. I'm not sure what that looks like. There's, you know, both ways. I understand. My point is I do see tokenization as an opportunity, definitely in the alternative space, where it gives that democratization for these middle income low-income individuals that may not have access to this asset class that gives a little bit more capital for this space. I just wanted to get your perspective on that. Do you see that definitely with your
I don't.
thesis?
You tried, but I'm not sure you can completely de-link crypto and tokenization at the same time. But you probably, I mean, it's arguably, I guess you can. But I think you should probably, we could start talking about crypto just for a second. The question with crypto is it really going to catch on? Is it, and as a separate asset class and all that? I think the answer is, in the long run, it will, and it's here to stay. I think when it comes to blockchain technology, there's where it's going to really thrive is where it finds practical applications, right? And so tokenization is a little bit headed in that direction. I would caution the average investor from getting in too soon, and I think it's a diversification play, and I really caution anyone to say, like, jump in. There's that FOMO mentality that people don't want to miss out on the next wave. Great. So take 5% of your play money and consider putting it in. But I would hesitate to say, think of it as a pure investment play. I'm not convinced that it is yet. And we looked at running a crypto strategy for a while, and it was convoluted because they kept changing the rules on us and the margin requirements and all this stuff, and we're like, you know what, this is just not ready for prime time. And so we've been on the sidelines now for a while. We think being in cash has been the right call. So anyway, I would just say be careful in that regard for any exposure there. And for any investors thinking of going in that direction, I would just counsel, be cautious with the amount you've dedicated to that space.
Yeah, and I appreciate emphasis on that. I was just curious in the context of tokenization in regards to, I understand there's a lot of platform where, you can, like crowdsourcing, et cetera, for a lot of startups. We can deploy some capital in that for VC world startups. But the thing is with startups, you and I know about 98% of them fail. And so it's nice that it's accessible for a lot of middle income, et cetera. However, I'm just curious with tokenization, a lot of private equity, you're talking billion-dollar acquisitions and roll-up strategies and all sorts of things. And I'm just curious if they can structure the token as instead of $100,000 or $300,000 or $1 million kind of minimum check, now you're talking maybe $100, $200 for each token, and then that could be leveraging some of these individuals' structure.
I think you're right. There's sort of the democratization and access, right? And that goes back to your so that makes sense. And that's probably a good thing. The more democratization of markets in general is a good thing. It sort of goes back to your earlier question about why aren't we well known? And the category isn't as well known as it could be. And it's primarily a structural issue. It's access. You can't create a mutual fund around it. It's hard to have an ETF around it. So many of us, so we're forced to offer these in private investment vehicles. And because they're private, I can't even talk about them. Right, because they're offered privately. So that's really the answer to your question about why isn't as mainstream as it could be. Is just because it's still in the private realm, and so for somebody looking to invest in this world, they actually have to do a little bit of homework and a little bit of digging, and so that's what I think is why.
But what I love about this is that that's the opportunity as well, because when there is lack of access, there's like this there's all these hurdles, but there's also that amazing opportunity. That's why I appreciate you being on here, sharing this and understanding that looking outside of the U.S. markets, we're still saying, yay, gung-ho U.S., but also looking at global markets is like, hey, might as well jump on those ships as well, because we're seeing big up to the right trajectories for a lot of this stuff and having these different strategies. Ted, I really appreciate being on here and just unpacking it at a very micro level, your strategy, your thesis, your journey, and really understanding how to look at this and bringing just an incredible amount of value to our audience, and just understanding this is just a very asset class that a lot of people are very not familiar with. And I appreciate just explaining really at a foundational level why this is so important and for a lot of our audience to understand this. So for those that want to reach out to you, you guys have tons of resources on your website, but how do they engage with you? How do they reach out to you? How do they answer a little bit more, ask a little bit more questions from you, Ted?
Yeah, thanks very much, Christian. It was a great opportunity. I love talking about this because it is what we do and why we think it's so important. And there's a number of studies that support what I say. They can take it from me. Yes, they should, absolutely. But there are a lot of independent third-party studies out there that support the efficacy of approaches like ours. I'm not alone. I'm not the only quantitative manager in the entire space. There's a lot of us. There's the big guys that maybe are even some ways easier to access. There are a lot of smaller managers like ourselves that specialize and have access, like I said, to even all the greater markets. The way to get us is to come to us directly. That's the easiest way. We are on some platforms. We have there are some private investment vehicle platforms out there, like Interactive Brokers has a hedge fund marketplace that for clients of Interactive Brokers they can find. Schwab, for example, has a hedge fund platform. Fidelity does. There are ways to find these private investment vehicles that you can reach out and get access. But calling us directly, obviously, it works well. You go to our website and find emails directly. InclineIM.com is the best way, and we're happy to deal with any individual investor that wants to talk to us. Like that's how we've grown our business. And one of the things that when I talk to anybody, though, I'll qualify them like I need to. I want to make sure that it's a suitable investment, right? It has to be because from our suitability is a regulatory requirement. For me, it's just a good business decision. I want to make sure my investors, know what they're getting into. I want to make sure my investors understand what they're getting into and that it fits with their overall investment portfolio. So that's how I approach it.
100%. And guys, those links are in the description. That is inclineim.com, that website. He's got tons of resources on there, as well as I put his LinkedIn down there. Also, he's been featured in a lot of different places. So just tons of incredible resources, tons of blog content for those that want to consume a little bit more and then reach out to him and his team. Ted, I really appreciate you being on here and just unpacking this at a very deep level. I learned tremendous amount. I'm realizing now, looking at my strategy, that I probably need to look at a little bit more, external global markets. I'm not as heavily invested in that, and that's a conversation we'll probably have to have. Ted, I always love to ask my guests before I let you go fully, is there any last words of wisdom they'd like to share with our audience?
Thanks. Of course, I don't have any prepared, but I will just say thank you very much, Christian, for the opportunity. I love your energy, love the other podcasts that I've seen on your website. You're doing a great job, and anytime I have an opportunity to talk to investors just about how they can, add more global access and why it's important and why it can add value, I'm happy to do that. Love talking about it, and just encourage anybody to reach out directly. So thank you very much for this opportunity. Really appreciate it.
You got it, guys. That is the CEO and founder of Incline Investment Management, my friend Ted Parkhill. Guys, that is Journey with Christian Diev's podcast. Until next time, be uncommon if you can.